Good morning, everybody. And as Danny said, I'm Edward Rands. Very, very pleased to be here, back at CP, back in person. I spent 11 years as CP's technical partner before moving on to do slightly different things 2.5 years ago. So it's especially gratifying that they still ask me back to do things like this. I only have 15 minutes, so I need to crack on. So let's go with what we're going to talk about. I can't ever help doing anything without putting a disclaimer in. So this is general advice that I'm going to talk about. If you're thinking of doing anything sort of earth-shattering or not doing anything earth-shattering as a result of what I say, get some specific advice before doing so. When I was asked to do this, and told I had only 15 minutes, I thought, well, that's not very long to talk about anything at all. And then I thought, well, what's actually gone on with accounting standards lately? And the answer is not very much, really. There's been little in the way of very recent or significant imminent developments. I'm sure we've all heard a lot in the relatively recent past about things like IFRS 15 on revenue, IFRS 16 on leases, the accounting impact of COVID-19 and so on. And that's been covered to a huge extent. So I'm not going to talk about any of those today, but then we get into a bit of a problem because UK accounting standards have been fairly quiet since the previous update to FRS 102, which became effective in 2019. There have not been any real major developments in IFRS since, as I say, IFRS 15 and IFRS 16 came into force. So what is it to talk about? Well, there's one thing now, one big thing now on the horizon, which is the FRC's periodic review of UK accounting standards. And that's what I'm going to spend the majority of my 15 minutes, or probably now 13 minutes on. There are also some relatively minor changes to IFRS which are coming up, which I'm going to just rattle through at the end. So, as I say, the big forthcoming change relates to UK standards, and that is the FRC's, the Financial Reporting Council's periodic review of FRS 102 and the related UK standards. So this was announced a few weeks ago. The existing version of FRS 102 was published in March 2018 after a review process which kicked off in 2016. And the amended standard, as I've said, took effect for accounting periods commencing on or after the 1st of January 2019. There have then been some fairly minor amendments to FRS 102 since then, fairly narrow scope stuff, things relating to interest rate benchmark reform, COVID-related lease revisions, not really a lot else though. The FRC told us at the time that FRS 102 was first issued that they would review it periodically and update it. And this is the sort of the second one of those processes which is kicking off now. The FRC are limbering up really at the moment to revise the standard, and the revisions that are made are expected at this stage to be effective for accounting periods commencing on or after the 1st of January 2024. Okay, so effectively, by and large, December 2024 year ends onwards, although that could change as things progress. So the process is kicking off. There is considerable outreach on this. So at the moment, the FRC are seeking views on areas which they might look at as part of this review. And we'll look in a few moments. You have a number of opportunities if you feel that you want to make your views known on this and input to the process. I mentioned there's a series of other UK accounting standards alongside FRS 102. Here they are, just to rattle through those. So FRS 100 is the one which tells everybody what they have to do, who must follow full IFRS, who can follow FRS 101, who can follow FRS 102, and who the micro entities, the very, very smallest end, applies to, who can apply FRS 105. FRS 101 gives a reduced disclosure regime for entities, group members usually, who are otherwise applying full IFRS. FRS 102, as we know, is the main UK and Ireland accounting standard, and FRS 103 is very, very narrow scope and deals with accounting for insurance contracts for insurance underwriters and insurance companies and so on. FRS 105, as I say, applies to the very smallest end, micro entities, £632,000 turnover, £316,000 total assets. There's an FRS 104, which deals with interim financial reporting, and that technically isn't an accounting standard, and it's not part of this review process because it doesn't deal with recognition and measurement and presentation. So the review that's getting underway will focus on FRS 102, but it could drive consequent amendments then to the other standards which are set out here. So what kind of things might change? Well, the press releases that the FRC has issued at the moment suggest that the process is going to be very, very open. So any reasonable or sensible comments which get submitted to them, they will take into account. But there are some obvious areas, and they've sort of specified the areas which they are going to be looking at in particular. So they will look and think about new issues and new types of transactions which have presented themselves, which come into existence since the last time that the standard was revised. They will look at improving existing requirements in the current standards to make them more responsive, to provide better reporting results as a result of those requirements, so improving what's there. And then it's also worth remembering that going right back to the point that FRS 102 was initially issued, the FRC said, well, we're not going to mirror IFRS necessarily to the letter, but we will try and broadly follow the principles. So they will definitely take account of the more recent developments in IFRS since the last time that FRS 102 was revised. Let's just have a look at these in a little bit more detail. The ICAW has done some research on the kind of things which might actually change. And so in relation to the first of the strands that I mentioned there, in terms of recent developments in IFRS, IFRS 9 is a possibility. IFRS 9 deals with financial instruments. It introduced what's termed an expected loss model, which requires certain financial assets to be subject to a loss allowance based on expected credit losses. Fairly complex stuff, lends itself fairly well to IFRS providers. There doesn't seem to be a lot of support for incorporating anything like that into FRS 102, but it's possible. More likely, a change is feeding from IFRS 15 on revenue recognition. So IFRS 15 introduced a comprehensive model for when you will recognise, at what point you will recognise revenue and how you will measure revenue, what's termed everywhere apart from the standard itself as the 5-step approach. And the Institute, the ICAW's view, is that there may be at least some aspects of the IFRS 15 model which would lend themselves well to being incorporated into FRS 102. Although there's a counter argument that again would be introducing increased complexity, and there's a need to ensure that any additional costs in dealing with that increased complexity are justified by the benefits of higher quality financial reporting information being produced. And then finally, the other sort of big recent IFRS development, IFRS 16 on leases. Again, that introduced a sort of a single lease accounting model, which brings pretty much every leased asset onto the balance sheet. And this is perhaps one which introduces the most debate, because it's accepted probably that many entities which are eligible to apply FRS 102 might have complex lease arrangements, and so it might be sensible to introduce some sort of IFRS 16 type model into FRS 102. However, The thing about IFRS 16, for anybody who's had experience of it, is it is pretty complex stuff. And again, it's not necessarily desirable to introduce that complexity into FRS 102 to any great extent. So any IFRS 16 principles which are brought in would need to be very heavily simplified. And more generally, the consensus seems to be in reflecting IFRS changes in FRS 102, it's that cost-benefit analysis. Do the benefits of higher quality financial information justify the additional complexity and therefore the costs which will result? That's IFRS changes, new issues and transactions. Now here are two images which I never really expected to be sort of necessarily putting together on a slide, but the two main areas here are firstly climate-related risks, which is a fast-evolving area, really. There's a good deal of current thought on how you might identify climate-related risks, how you might place a value on them in a set of accounts. And there are also an increasing number of things such as carbon trading schemes, emission trading schemes, and no guidance in the likes of FRS 102 currently about how you account for those. And these are clearly urgent matters. Things are moving on very, very quickly, obviously with climate change and the way that the world is reacting to it. And although the international standard setter, the IASB, is working hard on dealing with those kinds of things from an IFRS point of view, usually the FRC will take its lead from the international standard setter on the way that the UK standards move, but it may be the case that they decide to sort of take the lead themselves on this from a UK point of view and not wait to be guided by the developing principles of IFRS. And then the second big sort of new issue, if you like, is crypto assets, Bitcoin, and the likes of that. Again, fast evolving area, many new, quite unusual concepts for many of us, but the only certainties really seem to be that these kinds of things are here to stay and will become more and more important, and so accounting standards will need to deal with them and show us how we report on such matters. So once again, really, the IASB is working on this. The FRC might wait to sort of follow their lead, or they might say, well, we're going to crack ahead with this ourselves on the back of this current review. And then finally, improvements to existing FRS 102, bug fixing, if you like, possible opportunities there. The approach to small entities. So Section 1A applies to entities qualifying as small. FRS 105 applies to micro entities, as I mentioned. The requirements in those are almost completely driven by EU accounting directives. So the EU said these are the rules for how you will deal with such entities. And now the UK is no longer in the EU, there may be more flexibility there for the FRC to say, we're going to do this a bit differently and change things from what we do at the moment, perhaps make things a bit more or even more flexible for those kinds of entities. Requirements on government grants are currently, in FRS 102, are currently held to be slightly bizarre, shall we say. Those have been tested to destruction by COVID-related support. Serious quantities of government grants are being received by entities following FRS 102, which have led to some, in some cases, some fairly curious financial reporting outcomes. So that may be revisited. And then the transition section, section 35 of FRS 102, currently talks about transitioning from old UK standards, which became defunct now 5 or 6 years ago. So that needs to be re-engineered to talk about transitioning from IFRS or from the micro entity standard and so on. So scope for some updating there. Outreach, how can you contribute? Well, there's a webinar on all this. There's going to be some notes circulated backing this up. You can attend a half-hour webinar on Monday the 13th. The link is up there. The link is in the notes. The FRC will then undertake some round table sessions. The dates I've given there. And again, there's a link if you want to sign up for one of those. And I've placed that in the notes that I'm issuing as well. And there's also a podcast that you can listen to where one of the FRC directors just gives more information of what's going on and how they see the process moving onwards to the ultimate amendments to the standards. So there's outreach which you can take part in there. If you have any burning issues on FRS 102 or the existing standards, things you don't particularly like, or even things that you do particularly like, you can email them in to the FRC at that address. The closing date there is Halloween, October the 31st. Okay, that's UK standards. That's my rattle through of that. Very, very quick run through of IFRS amendments. Some stuff on interest rate benchmark reform, the phase 2, second phase of that is effective for accounting periods commencing on or after the 1st of Jan 2021. This is to do with the phasing out of things such as LIBOR and other interest rate benchmarks. Phase 2 deals with what you do after the existing benchmark has been replaced. IFRS 3 on business combinations is subject to a minor change to refer to the latest ISB conceptual framework. I won't go into that in any more detail, but that's effective for accounting periods commencing on or after the 1st of Jan 2022. There's a little amendment to IS 16 on property, plant and equipment, which says if you're constructing a fixed asset or bringing it into full-time use, anything which it produces during that period before it's fully operational, anything which it produces which you sell, you can't knock the proceeds off the cost of that fixed asset. You have to treat them as sales and purchases through your profit and loss account. There's some clarification in IS 37, which deals with provisions on when you're looking at whether a contract is onerous, which costs you take into account in determining whether or not it's onerous. And again, that's effective for accounting periods commencing on or after the 1st of January 2022. And then finally, there's a series of very minor annual improvements to IFRS more generally. The ISB carries out a periodic process, just looking at all its standards and say what bits can we improve around the edges. Again, I won't get into those, but I've listed those out in the notes, which will get circulated to you after this event. There's my contact details, that QR code there. If you point your smartphone at it, you can link up with me on LinkedIn if you like. And that's it. I'm done.
Well, first of all, good morning, everyone. I'm Suki Kaur. I'm a tax partner. I work in the business tax team. In this particular session, I've got the great job of talking you through the financial support that was offered during the coronavirus pandemic. Well, as we all know, the government has had to borrow and spend billions to support the economy, but also to fight the coronavirus. Now, I had a look at some of the numbers, and in the period up to April 2021, the government had borrowed £300 billion. Now, that's the highest that we've ever borrowed since records began in the 1940s. We're expected to borrow a whole lot more. So the current projections are that there's going to be a further 200 billion that we're going to have to find and slap on the credit card, really. Now, of this 500 billion, I should say, 150 billion of that has actually gone into ploughing into and supporting business to actually prop them up whilst the pandemic's been going on. Now, we've been quite busy in the tax team, let's say, for the past couple of years. We've had over 80 tax policy announcements. Now, some of those have been, well, the one that I really enjoyed was Eat Out to Help Out. Some of them have been deferrals. We've also had government loans, and we've also had some real cash that's been ploughed in, and that was really in the form of the job retention scheme. It's inevitable now that really the tax policy is going to continue to evolve. So we've already seen, we've had the changes to the the corporation tax rate. So we know that that's up and coming on the 1st of April 2023. We're going up from 19% to 25%. And even just, it's topical, like in the past couple of days, we've had the announcements now on the national insurance proposed increase of 1.25% for both employees and employers. And we've also now got the date for the budget. So that was announced this week. So that's on the 27th of October. So we're expecting a whole lot more. And we've as a firm, we've had a COVID task force, which we put together, and we've been going through all of the detail of all of these announcements for the past, 2 years. It was quite interesting because we actually had our formal closeout party for the COVID task force on Friday, which felt like a great thing. So next, I'm just going to focus on the key support that's still available. So coronavirus job retention scheme. Now that was it was the area that we were getting the most traction from as and when the updates were going through the scheme. The rules were changing, what you could claim, what you couldn't. We were inundated with clients with queries on that. So we've got Tara, who worked with me on the task force, and she's going to be going through some of the detail on that just a bit later. But before we do that, we have still got some support that's available. So statutory sick pay, it's possible to claim for an employee. Now, if that's off for coronavirus, or even that they're self-isolating. Now, it's about £100 per week for employee, and the rebate is claimed through HMRC's online service, and that support, it's all still there, it's still available. No end date there. We've still got the reduced rate for VAT, and that's available 5% until the end of the month. And then we're going to go up to 12.5% until the 31st of March. So time to pay. Now, time to pay has always been a concept that has been around. So if you've struggled to pay your tax bills, what happened though during coronavirus, it just became a whole lot easier to get a time to pay arrangement. So some of our clients were ringing up the coronavirus HMRC help desk, just saying the word COVID, and they were getting a time to pay arrangement. Now the experience that we've got is that there's a lot more information that's required to actually support actually getting that time to pay, so profit forecasts, etc. If you are in a time to pay, then just remember to pay, because it can be withdrawn, and that's quite important for cash flow, etc. Next one is business rates relief. So if you were eligible for this, you should have been contacted by your local authority. So it was up until the 1st of July, we've had 100% relief for business rates. And there was no cap on that. From the 1st of July, a cap's been imposed. So it's £105,000 per business that you can claim. However, if you were closed at the 5th of January, then the cap for you is slightly different. It's higher, it's 2 million. Now, what's interesting with business rates is that back in the background, there is a consultation that's going on business rates. That was announced in last year's budget, and we were expecting changes. Now, there's been constant delays to those changes being announced, so we are expecting that we will get something imminently on that, on what's going to happen with business rates going forward. What's also quite interesting is that, this was for the retail, hospitality and the leisure sectors, and the retailers, the food retailers did really well, and they'd had all of this business rates relief. And so in terms of like the profile of some of these the food retailers, so for example Tesco, they repaid £585 million of business rates back to the government. Similarly, Sainsbury's, Asda, Aldi, and many more have kind of followed suit. So yeah, more to come on business rates. So we did have a number of loan agreement and loan packages that were kind of put in by the government, and the latest one was the recovery loan scheme. Now that one, it was announced in March this year, and it's up to £10 million, and that's for businesses of any size. Now Now it's 80% of the government guarantees 80% of the finance. What you need to show though is that your business has been adversely impacted by coronavirus, and also that you've got a viable business there anyway. So the British Business Bank's website, it's got a list of all of the lenders. The terms are for up to 6 years, so worth having a look at. One other point that I just want to cover before I hand over to Tara is in relation to losses. So if you're a company, or actually an unincorporated business as well, and as a result of coronavirus you've incurred a loss, then previously what you could do with your losses is you could carry them back for 12 months. If you paid tax in that period, you could reclaim that tax. You could also carry your losses forward and hopefully set them off against your future profits. Or what you could do if you're as part of a group, you could group relief. So if you had another profit-making company in the group, you could surrender your losses there. Now those loss carryback rules have been extended. So instead of only being able to carry back 12 months, you can now carry back 36 months. So this kind of impacts a company or a business that's incurred a loss now, but then has paid taxes in the past. So you can now, there's a refund that's potentially subject to a cap, but it's potentially worth £760,000 if you can carry back that full amount. So if you have got losses and you've paid taxes in the past, I just urge you to speak to your CP contact to investigate whether you are eligible to make this carryback claim. I think that's it from me. So I'm going to introduce you now to Tara, who has been busy going through all of the detail on the job retention scheme, making claims for clients, and you're up.
Thank you. Hi everyone, so I'm a tax manager here at Keeper Parry, and as Suki said, I was lucky enough last year to be part of our COVID task force, and in particular I was looking at the coronavirus job retention scheme. So ever since the scheme began last year in March 2020, I've been helping all of our clients with all their queries, making and submitting claims, and just keeping on top of all the announcements. So I thought I'd just run through some of the key statistics. And this just shows the extent of the relief that was available and how valuable it's been for businesses. If you can all cast your minds back, it was actually the 20th of March 2020 when Rishi Sunak stood up and announced the start of the scheme. So massive announcement. He was saying that the government were willing to fund 80% of employees' wages up to £2,500 per month for people who couldn't work during the coronavirus pandemic. And at the time as well, they were also covering employees' national insurance and pension contributions. So massive sigh of relief was breathed by businesses across the UK. But it was also a sign of the strict restrictions that we could expect to come into place. And then 3 days later, 23rd of March 2020, that's when Boris Johnson announced the UK's first national lockdown. So you can see here the statistics about the scheme. These figures here are correct as at the 30th of June 21. We did have Freedom Day on the 19th of July, so it'll be interesting to see how that day affects these figures. We're expecting those figures to be announced tomorrow, so we'll know more then. And what I do just want to point out as well is that HMRC estimate that up to £7 billion could have been claimed fraudulently through this scheme. So we're pretty sure it's going to be a hot topic for HMRC inquiries in the next few years. And this is just a bit of a potted history, the key dates of the scheme. So the scheme is due to come to an end at the end of this month, and your final claims need to be in by the 14th of October. And it's just worth thinking about cash flow. So if you've still got staff that are on furlough now, and you're going to be bringing them back from October, that might be the first month that you need to cover all of their wages, and you won't be able to claim any more from the scheme after that. So it's just worth having to think about cash flow and how that's going to affect your business. And just some reminders, so it's also worth just having an audit in terms of what records have you kept in relation to your claims. So it is a legal requirement to keep these records for 6 years. And as I said, with that £7 billion estimated fraud figure, HMRC are going to be carrying out inquiries. The only insight we've got on that so far is we've actually not seen as much activity from HMRC yet as we would imagine. I spoke to people who provide our professional fees insurance, and at the moment they're seeing about 20 claims a day coming through for these inquiries, and they've also been told by HMRC that they're not going to be picking up any more open claims again until at least the end of October. 20 claims a day might sound like quite a lot, but it's really not in terms of the number of clients that they look after. So I think HMRC are probably just going to be getting together a crack team, hopefully training them up properly, and then we'll see more activity to come. And the final thing I just want to pick up on as well is there's some extra boxes that will now appear on your corporation tax returns. So just bear this in mind, there are some extra disclosures you need to make. You will need to disclose how much you've claimed under the job retention scheme, how much you are entitled to. So if there is a difference between those two figures, this is kind of HMRC asking you to self-assess that difference if you've made an overclaim, and this is your chance to voluntarily disclose that and pay it back. And you'll also just need to let them know if there's been any overpayments that have already been disclosed as well. So just be prepared to put these on your corporation tax returns. That's it from me. So the end of the scheme this month, but I don't think we've seen the end of the story so far.
This is me. I'm an assistant manager in the indirect tax team. You can call me Ali. My friends call me Ali, and you might have spotted that makes me Ali G, which has not gone unnoticed by many people in the team. So just a quick overview of what we'll sort of look at today. So we've got an overview of the VAT and IDT changes. So when I say IDT, I mean indirect tax. It's a bit of a mouthful. Some changes that we've had in the last 12 months and Scoop. Brexit, some changes to e-commerce rules. I'll do a quick overview of COVID-19, and then some key risk areas for VAT and indirect tax, and then some takeaways, which unfortunately isn't a dominoes. It's a list of things that hopefully you'll have learnt from today. So over the last 12 months, we have had over 142 new indirect tax cases, 185 HMRC manual and guidance updates, and 31 changes to indirect tax legislation. So every week we kind of have an internal email to keep up with CPD, keep up with the changes. Just kind of wanted to highlight how fast and how quick things can change, especially in the last 12 months because of Brexit. So it's really important to kind of stay on top of things and make sure you're staying up to date. So we've also got Scoop. So Scoop is our monthly e-newsletter, which is filled with any kind of technical updates, any updates about our teams, those kind of things. And we submit our sort of newsletter to Scoop every month. So what we do is we just take those important updates, turn them into a line or two, cut out all the waffle, all the jargon, and hopefully that might be sort of helpful for you. Important dates, changes, anything that you might need to know. So that actually gets sent out to a mailing list. So if you're interested in joining, feel free just talk to one of us afterwards. But you can also see our VAT and indirect tax on the Parry website. And then we've got our timeline. So I quite like this as a visual. So it's just everything that's happened over, well, not everything, but lots of the important things that have happened over the last 12 months. I won't go over all of them, but I would say probably the most important ones, we've got post-owned VAT accounting for anybody that imports. We've got your mandatory MTD digital links, which is really, really important. That came into force back in April. As Suki and Ty mentioned, we've got the end of the temporary reduced rate for hospitality in September. That goes down to up to 12.5%. October, as of the 1st of October, there's no more stamp duty relief. And then December 2021, we have another Brexit deadline for your compliance obligations. So can't avoid it, Brexit. If you said Brexit to me in January of this year, I would have screamed and ran and hide. But I'll try and keep it as light and breezy as I can. I know nobody wants to sit here for 20 minutes and listen to Brexit. You've probably heard enough by now. But essentially, pre-Brexit, a lot of the law governing VAT and customs came from the EU. We had to follow the case law judgments. We kind of had to follow their legal position. But obviously, as of the 1st of January, that changed. For the most part, most EU law that was effective in the UK was kind of transposed into UK law and still applied. But unfortunately, this was not the position for most VAT and customs. So we came up with something, well, not as a team. I wish I was part of it. But the government came up with, obviously, the trade agreement. So it's more significant for customs than it is for VAT. But just the kind of headlines. So we've got zero tariffs and quotas on trade between the UK and the EU when they meet the relevant rules of origin. You've got rules of origin, so that only your originating goods benefit from these access arrangements. And then we've also got the mutual recognition of your AEOs and your security and safety schemes. So this is my preferred Brexit strategy. Quite like to go to the pub, have a pint, and wait for it all to blow over. But unfortunately, it's not doable. I don't know if anybody's a fan of hot fuzz or whether that's just me. But yeah, unfortunately not doable. And this might demonstrate why. So I got this from the Institute's government website. I won't go into detail because I think we'd be here all day, but just kind of wanted to demonstrate that this isn't a 12-month thing. It's not a 24-month thing. This goes all the way up to 2028. So we can't run away and hide. We're just going to grab the bull by the horns and try and deal with it the best we can. So your risk areas really from Brexit and the main changes, obviously your international movement of goods, that's changed completely. Some changes to international services, Northern Ireland, statistical obligations, cross-border refunds, tax representatives, and there has been some changes to that liability of supplies. But your movement of goods is really the biggest one. So before, when we were trading with the EU, you'd have acquisitions and dispatches. And then for anybody that was non-EU, that would be an import and export. So now it's just imports and exports. So we've had to kind of change the way that we move goods in and out of the country. We now have to do some compliance work. So some paperwork. There's a form called a single administrative document, which is called a SAD, which is quite apt because it's very long. It's quite complicated, and to be honest, it's quite time consuming. So many businesses appoint an agent to do that for them. You generally need to make these declarations in respect of goods that leave and enter the UK. We've also got now our UK global tariff, which applies to goods imported into the UK from the end of the implementation period. But obviously this doesn't apply where your goods meet the rules of origin requirements. And then if we move down here, I think probably one of the most important things that's come about is postponed VAT accounting. So actually pre-Brexit, you could recover and pay your import VAT in a VAT return for sort of non-EU trade. But now we are non-EU, we're just us. So the government have introduced, and HMRC have introduced postponed VAT accounting, so you can report your import VAT and recover that in the same return, which obviously has great cash flow benefits as well. International services, so I won't go into too much detail on this one because it can be quite niche, but I thought it was worth flagging. So the place of supply is the place for VAT purposes where you actually make the supply, and that's where you're charged and you pay VAT. So as of Brexit, there's been some changes which could mean that you would need to register an account for VAT in a country if you were found that was the country of supply. So for example, if you were found to be making supplies in France, you might need to register an account for VAT in France, which obviously I can imagine from a compliance perspective, we'd like to minimise that where possible. So cross-border refunds, in short, can't do them anymore. So you used to be able to reclaim the VAT that you incurred in the EU via your HMRC portal. You can't do it anymore. You now have to do it by a paper form, unfortunately. And then just a couple of other bits. So tax representatives. So if you're dealing with any VAT obligations in EU member states, you might need to appoint a tax representative. So this is somebody that would be technically liable for your debts and your compliance defaults if that ever were to happen. It's not in each country, it does depend on the territory, but that's definitely something to look into. Your liability of the goods. There are some changes effectively immediately after sort of Brexit. So fund management, handling of goods, dispensing drugs. Again, that's only a couple of changes, but still worth flagging. And your statistical requirements. So your EC sales lists are no longer required, but you do still have to complete some intrastat things. So in July 2021, I can't remember if I actually put this on the timeline, but there were some changes to EU e-commerce, which were, I think it was planned to go ahead anyway, even though it's post-Brexit. UK businesses are unfortunately still affected. So the EU introduced these rules, as I said, in July 2021. So it affects business to customer supplies of goods and services. That's a little bit complicated, so I'll read from my my flashcard. So it really affects a number of businesses that are involved in the movement of goods from Northern Ireland to the EU, and also low value goods as well that are imported. And I think one of the major sort of sectors affected are those that operate on online marketplaces. So it's well worth looking into if that's something you do B2C sales online. But really, I feel like what you want to know is, what do you need to do if you're affected? So I think the key message here would be a supply chain review if you're selling goods, because there's legal and compliance obligations all along that supply chain. So really getting your house in order is extremely beneficial, especially if HMRC ever come knocking at your door. But really, OSS registrations, so you need to make sure that all of your compliance is in order. Review the VAT treatments. As I said, some of the VAT treatment for services has changed, so just make sure we're on top of that. And then down here as well, review your accounting systems. I feel like that's one that's quite often forgotten about. So making sure that your accounting systems are set up to deal with these different accounting treatments, making sure that they can gather the correct information to populate your VAT returns, your interest at, those kind of things. Obviously, if anybody wants to discuss these in more detail, it can be, we can sort of talk about that a bit later. But yeah, I'll go on to COVID-19. I won't go into too much detail as well, because I know Suki and Tara have covered it. But this was just kind of to highlight the changes just from an indirect tax perspective. I would say in general, the theme was just HMRC showing quite a lot of flexibility, quite a lot for HMRC. I wouldn't say a lot of flexibility, full stop. But, you know, your reliefs and measures for imports and exports, payment deferral was obviously such a popular one. Delays to the implementation of certain VAT measures so that businesses didn't have to deal with Brexit, COVID, and, you know, MTD and all of those kind of things. So just spreading those out a little bit more. And also, if you're applying for anything from HMRC, they have actually put some email addresses on their for their departments now, so you can, I know you can contact them by email rather than post, which has been very beneficial over the last couple of months. So really, what to look out for, I think, is probably one of the most important things. So where would there be a VAT or indirect tax risk for you? Any transactions to do with land and property can be notoriously difficult. Complex supply chains. So if you have a supply chain that spans the world, that spans the EU, that can also be quite difficult. Any acquisitions or restructuring, your deal fees can be quite a hot topic for VAT as well, and can be quite complicated. Compliance, as we said, reviewing your accounting systems, making sure that you've got the right information to stay compliant as well. Your imports and exports, as we looked at earlier, just the movement of goods. Your evidential requirements have changed substantially, so it's so important to make sure that you're keeping the right records just in case HMRC come knocking at your door. And again, HMRC inspections, you just want to make sure everything's right, because there's nothing worse than HMRC turning up and them uncovering something. You want to make sure it's all sorted so that when they come knocking, you can give them everything they need, and they'll happily be on their way. So takeaways, again, sorry, it's not pizza. Just get your ducks in a row, really. So are you up to date with your obligations? Have you reviewed the VAT liabilities post-Brexit? Are you comfortable with your position after e-commerce changes if you're affected? Are you ready for the withdrawal of certain COVID measures? So that would probably affect your hospitality and leisure sectors the most. And are you affected by any of the key risk areas? Is anybody building an office block and needs some specific VAT advice? Or are you comfortable dealing with that yourself? But yeah, we'll take questions at the end, obviously, and we can talk outside, because it can be quite a long conversation about that, to be honest. But yeah, thank you very much, and I hope I haven't sent you to sleep before your comfort break.
I'm Donna. I work in the R&D incentives team here, and I've been working in R&D since 2008. I've worked for a number of companies across various sectors, and today I'm going to talk you through what is R&D for those of you that haven't come across it before, and then a couple of updates as to things that have been going on with the revenue.
Do we just press it up?
Okay, so a lot of you in the room may already know what R&D is, and you may already be claiming, but for those of you that aren't, basically, in a nutshell, there's 2 criteria that you have to meet to be able to claim R&D incentives. So to make it really simple, because research and development sounds very technical, it doesn't have to be. So firstly, if your business is making a change of some sort, so whether that to be to a product or a process, then you may be eligible to claim back some money for the time and effort involved for making that change. Secondly, to make that change, it has to be challenging. Not challenging to your everyday person, but challenging to the competent professionals within your business. So why is that important? If you meet both of those criteria, you can claim incentives from the revenue that can be anything from 10 to 33% of your time and effort invested in those changes, and actually get that money back from the revenue. So it's a really, really excellent relief that helps your cash flow within your business. So moving on, recently there was a consultation. So March this year, the revenue issued a consultation to claimants and advisors, and they raised a series of questions because they want to continually build on the R&D regime to make sure that it's competitive with the regimes offered in other countries. So we as Cooper Parry, we invited our clients to contribute towards that consultation. We provided our responses and we've submitted that to the revenue along with many other advisors. The revenue are currently looking at that and hopefully we'll be getting some updates soon. So to just touch on some of those questions that were raised. So firstly, with R&D, there's 2 regimes. Firstly, the SME regime, which is available to companies with fewer than 500 employees and turnover of less than 100 million euros, a balance sheet of 86 million euros. And that relief can provide anything from 25 to 33% towards those qualifying projects. There's a second regime, so if you don't fall within that SME criteria, you may be able to claim under the RDEC regime, so Research and Development Expenditure Credits. And one of the questions that was raised by the revenue as part of the consultation was whether those 2 regimes should actually be merged. Now that raises a lot of questions because firstly, the SMEs don't want to lose up to 33% of the benefit. They don't want to come down to the 10%, but I doubt the revenue are going to want to bring that 10% regime up to a benefit of between 25 and 33%. So the question was raised, a lot of responses went back as to how does that work in practice? More importantly, the SME regime allows loss-making companies to surrender their losses for a tax credit, and that's where the 33% benefit comes in. Now, if the schemes were merged and we effectively had an RDEC regime for all, then that may remove the ability to surrender those losses. So again, lots of questions raised. We don't know where the revenue are going to move with that, so we're watching out for the responses from the consultation. One of the other questions that was raised was whether the SME benefit should be shown above the line. So the RDEC credit is shown as an income, a taxable income, and a lot of companies like that because it contributes towards the EBITDA, but that isn't the same for SME companies. So the SME R&D benefit is made throughout your tax computation, so it doesn't touch your profit. Again, that's raised as part of the consultation. We don't know what the outcome is going to be. We're watching it very, very closely because we think loss-making companies in particular are going to be really impacted by that change. Thirdly, one of the other questions was whether there should be changes to qualifying cost categories. So within both the regimes, so SME companies, the main expense is your staff costs, and then you can claim things like consumables, third-party costs, utilities. And the RDEC regime is slightly different. So you can claim the same expenses apart from the third-party companies. So you can't claim for subcontract costs under the RDEC regime. So again, we don't know what that looks like. The revenue have asked the question. We don't know where they're going with that. In our response, we suggested some additional cost categories that we come across that we think should be included. So for example, we have a lot of clients that for particular projects, they have to hire in specialist equipment. And at the moment, that doesn't fall with any of the eligible cost categories. And that could be really important. So some of this specialist equipment, the higher cost could be significant. So we contributed towards the consultation to say that actually we think the qualifying cost categories should be broadened to include that higher cost. So again, changes are afoot. We think there's going to be changes to the R&D regime. We don't know what those changes look like, but we make sure that we liaise with HMRC closely. As soon as any of those changes are implemented, then we will be advising yourselves. We'll release announcements through our quarterly R&D newsletter, so keep your eyes out, and we'll, of course, contact any of our clients that we think might be impacted by any of those changes. Another important potential change that I wanted to highlight today is a case that was recently heard at the first tier tribunal, HMRC versus Heidi Engineering Company. Now, that case covered lots of different risk areas, but the one particular area that raised a lot of questions for advisors, and there's a lot of conversation going on in the industry at the moment, was around subsidised expenses, in particular the customer-led projects. So basically, if you're carrying out an R&D project, it might be that you're developing a new product. Now, commercially, you would want to make sure that there was a gap in the market for that product and that you could secure some custom for when you come up with that solution. Now, historically, we would have said that if you're taking on the financial risk, if you don't deliver that solution, you're not going to get any income, then we would be comfortable that if you met the certain criteria to be an SME, then you could claim relief for that project under the SME regime. However, as part of this recent case, the revenue started looking at some bespoke projects that Heidi Engineering were performing for their clients. So they had a contract to deliver a particular bespoke engineering product. Now, the company still took on the financial risk. There was no guarantee that they could come up with the solution. There was no guarantee that they could deliver that contract, so no guarantee of the income at the end of it. But the revenue's argument was you only fulfilled that project as part of completing that contractual obligation. So if it wasn't for that contract at the end, you would never have performed that R&D. And therefore, the revenue's argument is that that should be subsidised. Now, why is that important? Subsidised expenditure, where you've had income for a particular project, the amount of income that you've received only qualifies under the RDEC regime. So instead of getting that 25%, potentially 33% benefit, you've got the less attractive 10% benefit under the RDEC regime. So we're working with a lot of our clients. We are still interpreting the legislation as we believe it should be interpreted. So as long as you're taking on that financial risk, as long as there's no guarantee of any income at the end, if you don't deliver that solution, and you're not receiving milestones payments throughout delivering that project, then we still believe that you qualify under the SME regime. But it is a high risk area. It is something that the revenue are currently looking at. They're looking at producing some firmer guidance so that people know and understand how the revenue are interpreting that legislation so that we all have a consistent approach. Now, as you can imagine, as tax advisors, we want to make sure that the regime stay attractive to companies. We want to encourage companies to continue innovating. So we don't want people turning away projects that are for a specific client if they think they're going to get a lower rate of R&D relief. So we're working with clients closely. We're making sure that wording on contracts, wording on invoices isn't going to trip you up if ever the revenue come and raise an inquiry and start asking you questions. So it is an area that we need to firm up on. We need to get some really detailed guidance, and we need to make sure that if we are claiming under the SME regime and we're getting that higher rate of relief, that all of our records are in order so that if ever you do get an inquiry, the revenue then can't go in and sort of reduce your claim based on the audit trail that you have in practice. So that was all of the updates that I wanted to give you today. As you can see, there is an awful lot going on in the world of R&D. If you have any questions whatsoever, grab me afterwards or drop me an email and we can go through some of your queries. So next up, I'm going to hand over to Minesh to give you an update on IR35.
Well, good morning, everyone. So as you can see from the slide, I am doing a double act with Ginny Hallam today from Hallam, which I'll allow her to introduce herself a bit later on. But I'm Minesh Trivedi. I basically work with Parry on all things employment taxes, not just IR35. We brought to death otherwise if it was just IR35. But anyway, so I'm here talking about IR35, funny enough. And if you haven't heard of IR35 over the last 2 years or so, or even longer, then I'll be very, very concerned. But anyway, so what I'm hoping to cover today is really just to give you some background on IR35, just to give you an idea of where HMRC have come from over the last few years, what the rules are from 6th of April 2021, who they apply to, because there is a lot of misconception in my experience around who the rules apply to going forward. And then the clever bits, which Ginny will cover, is the next bullet point, employed versus self-employed, and some of the factors that HMRC look at in establishing whether it falls within or outside of IR35. And then I'll finish off on some of the how you can actually go about doing your assessments as an engager, and consequences of getting it wrong, and what next, what good practice really looks like. So just to take a few years back, IR35 obviously was introduced back in 2000, and the main primary reason for this was to try and discourage forced employment in HMRC's eyes. So people setting up limited companies, providing the services to the end user without or not paying enough taxes as a direct employee would. Clearly, there has been a growing problem over the years from an HMRC perspective. So in HMRC's eyes, by 22-23, in the private sector alone, the non-compliance would have cost something like 1.2 billion. I think it'd be a lot higher, where people aren't really applying the rules. And as you can see, the number of PSCs that have been set up over the years, and only God knows what it would be like in 2021. My guess is probably over 4 million. So it has been a growing problem from HMRC in people setting up and providing the services through a personal service company and perhaps not paying the enough tax or NIC to the Exchequer. But I think it's also fair to say there has been a lack of enforcement by HMRC until recently. Now, I say until recently, obviously, before the pandemic started, I saw quite a marked increase in the activity from HMRC doing just employment status and intermediary reviews on a number of companies. But clearly that's gone downhill a little bit. Like Tara mentioned earlier, they reckon there's a fraudulent claim on the CJRS of about 7 billion. Now, what I have noticed over the last 18 months, the resources have been ploughed into looking at that side of things, which means they are short of resource on other areas of HMRC. But I can see that being quite an important thing, given that the rules came in from April this year. I can see that accelerating going forward from an HMRC perspective. But also, I guess legislation was largely ignored by the PSCs, whether they didn't understand it a great deal, whether they just ignored it. But again, in HMRC's estimation, out of all those PSCs, about a third come within IR35, but only 10% of those apply the strict rules. So I think there's a combination of both why this hasn't been taken that seriously, but I can see that changing going forward. And in terms of some recent changes by HMRC, again, this is just to give you an idea. So if we go back to, so I said introduced in 2000, 2014, they tightened the agency regulations where they introduced the SDS, to try and get more and more individuals into the PAYE net. And then 2015, they introduced the employment intermediary reporting requirements. So where you engage services of an individual through an intermediary and you didn't apply PAYE, there was the obligation to make a quarterly return to HMRC. So it's all transparent to HMRC. And then 2017, obviously they introduced the off-payroll worker rules in the public sector to try and get as many people into PAYE as possible. 2018, they reduced the dividend rate to make PSCs less attractive in terms of dividends. So the allowance was reduced from 5,000 to 2,000. And of course, the plan was to bring or extend the reforms into the private sector from April 2020. However, because of the pandemic, it was delayed to 2021. So that's just to give you a flavour of where HMRC have come from and where they are likely to go going forward in terms of PSCs and increasing the PAYE NIC take. So in terms of who these rules apply to, so I guess what HMRC expect you to do is to identify all potential individual workers that provide their services through an intermediary. Now, clearly, the key change from April is all those other bullet points there. So the key change is where previously HMRC relied on the individual PSC or the worker to carry out the assessment as to whether they were within IR35 or outside, was left to them, to the individual worker. Clearly, from April, that responsibility shifts onto the engager or the end user who are obliged to carry out that test or do the assessment. And if they are within IR35, then the obligation on the engaging company is to provide what's called an SDS, status of determination statement, to that individual, although in practice, although the regulations state that you only give that statement to the SDS to the worker where they are within, what I'm experiencing in reality is clients are also issuing those to people who aren't within IR35, which personally I think is good practice, because if HMRC were to come along, then you've got some audit trail to show them, even if they were outside of IR35. And then clearly, if they are within IR35, the obligation is to operate PAYE and NIC EEs and ERS, and the apprenticeship levy if applicable. Clearly, all you're doing is treating those individuals as if they were your own direct employees, and therefore the obligation is to make returns to HMRC through the RTI process on a monthly basis. And I think the key thing is reasonable care. That's what HMRC are really looking for. So if you've got the necessary processes in place and you can show HMRC the documentation you've gone through in assessing an individual, then I think they will be more sympathetic, I guess. But what HMRC don't require you to do is to just say, we look at all our all our workers, and they're all within IR35 or outside of 35. They require you to look at each individual arrangement, unless you've got a group of people who are under the same T's and C's engaged. And clearly there is an appeals process. So if the worker doesn't agree with that determination of them being within IR35, there is the client-led appeals process, which means that they can write to you and say, don't agree with your decision. And then you as the engager or the end user have up to 45 days to respond to that with either a different answer or the same answer. But there is an appeals process. And clearly, this is probably not too relevant nowadays because we're over 5 months into the new rules. But clearly, the new rules only apply to payments and services provided after the 6th of April. So who do they apply to? So again, I raise that because a number of times I've seen clients think that these rules apply to individuals. One, no, the rules only apply to workers that supply the services via an intermediary. That could be a partnership, it could be a personal service company, or it could be other options. They don't apply to cases where you engage the services of that individual directly. So if it's in name, then the normal employment status rules have applied and will continue to apply going forward. Okay. But the tests are exactly the same. Looking at that third point, so the new rules only apply to small companies. And if you meet 2 out of the 3 criteria, then you will be regarded as a small company, in which case these new rules don't apply. If it's an unincorporated business, then the main test is the turnover test, and that's it, okay, as to whether the rules apply. Now, how do HMRC determine whether you are a small company or not? And the way is by reference to your filing date before the tax year. So if your filing date goes in and you meet 2 out of those 3 criteria, you'll be regarded as a small business or a small company. Now, you have to do that for 2 years consecutively. And that's really to avoid some companies coming in within IR35 and then next year not, et cetera, et cetera. So it has to be 2 consecutive years. And the last point there about group companies, those tests will apply to groups of companies. So it's a bit of an anti-avoidance rule that HMRC have introduced, and it potentially looks at the worldwide group if it comes to it to determine whether you are a small company or not. Okay. And with that, I'll hand over to Ginny.
Thanks, Minesh. So, hey, I'm Ginny. I'm a director and employment lawyer of Hallam, which is an employment law firm. So I'm going to talk to you about how tribunals and HMRC determine employment status as opposed to self-employed or worker status. If you've got any questions as we go through, we've got Charlie online, so fire through the questions to Charlie and he can pick them up for us. So, prepping for this session, how can I bring to life the test that HMRC applies when determining employment status? And really looking at the way that they apply it, they look at key ingredients
of a relationship to build a bigger picture as to whether employment status is there. So thinking through analogies and thought, what about the everyday sandwich? We've got key ingredients of the everyday sandwich, put them together and we can all identify what it is. Now, it could be any filling. I'm thinking, who am I delivering this presentation to? So we've got FDs, we've got accountants, we've got CFAs. You want something steadfast, don't you? You want something solid, reliable. You want something that's good value for money. So we've gone for cheese and pickle, but it's a filling of your choice, right? It doesn't matter. It works as we go through. So the starting point in terms of the test for status and the approach that HMRC takes is to look at this irreducible minimum, this minimum requirements, looking at the relationship. Is there mutuality of obligation? So mutuality of obligation is the equivalent of the bread to our sandwich. If you don't have bread, you don't have a sandwich. If you don't have mutuality of obligation, you don't have employment status. And what does mutuality of obligation mean? Well, as far as the individual is concerned, it means that there has to be some obligation to accept the work offered. They can't say yes and no constantly. There has to be an obligation, ideally a contractual obligation, on the individual to accept the work offered. And equally for the business and for the engager, there has to be some obligation throughout the relationship, so not piecemeal, but throughout the relationship, there has to be an obligation on the business, on the engager to offer work, or to make reasonable efforts to provide the work, to allocate the work fairly, or if work can't be offered, maybe some retainer in place. So we're looking for that irreducible minimum of mutuality of obligation. That's the bread to our sandwich. You can't have bread without butter, right? You can't have mutuality of obligation without personal service. And that's the second kind of irreducible minimum that HMRC are looking for. So in much the same way that we've got butter, we've got Lurpak, we've got lots of different types. There's kind of different types of personal service, but overall what they're looking for is an individual that is duty bound to perform personally, save in a few exceptions. So every now and then it's okay if the individual says, I can't do the work, but do you know what? You said in your contracts that if you're happy to consent to somebody else doing it, I'll sub somebody in on this one occasion. But not constantly. If you've got an individual that's constantly subbing someone in, then you're unlikely to have employment status. So we've got those two irreducible minimums. We've got personal service and we've got mutuality of obligation. So we're starting to look a bit like a sandwich, right? We've got our bread, our butter. But in much the same way as then we've got our fillings to our sandwich, what HMRC are doing is they're looking for lots of other factors then to tip over the balance and say, okay, we know we've got the irreducible minimum, but does this look and feel like we've got an employee? So we've got our analogy, we've got our Branson pickle, our cheese and our lettuce. Well, the equivalent as far as the employment test is concerned is all of the things that you can see on the slide. So what have we said in practice? What's in our contract? What have we written down? What about uniform? Do we supply uniform? Do we keep control of the individual? Do we supervise closely? Do they have to ask for holidays? Do we give them equipment? Do we give them tools? Do we discipline them if they don't do things wrong? Do we performance manage them? All of those factors obviously indicate that we're dealing with something that's employment rather than worker or self-employed status. So it's about the bigger picture. Once you've got those irreducible minimum, then you build up the bigger picture. You see whether it looks and feels, or the HMRC sees whether it looks and feels like employment status, looks at all of the balance and all of the factors in totality. They're looking for substance, not form. They're looking for facts, not what's written down. And if looking at the bigger picture, they determine that all of these status indicators are present, then they'll find that there's employment status. Thanks, Minesh.
So I guess how do you bring all that together is what HMRC will be after. How do you actually undertake that assessment? So a clear one there is obviously seek professional help, and where that really helps, in my experience, is if you are seen to have taken professional help or taken reasonable care, then chances are HMRC will be more lenient on any historic PAYE and IC liabilities, but also any penalties that they impose on those liabilities. The second one, obviously, there is the HMRC CES tool, which I'm sure you would have come across. Now, I'll be honest with you, I'm not a very, very big fan of it. And I think for some of the reasons that Ginny mentioned earlier. So if you look at, if you've ever used that CES tool, one of the things it quite clearly ignores is the mutuality of obligation. Now, in my experience over the last 24 months, etc., HMRC expected to rely or use that CES tool. But if you look at the tribunal cases, a first-year tribunal over the last 24 months, etc., a lot of the decisions have been taken on the mutuality obligation test, which tells me actually the CES tool doesn't really have that much value. But anyway, it is there for you to use. I'm not a big fan of it. It is HMRC's version of things, so use that at your peril would be my advice. So the consequences of getting it wrong. So what if you've gone through all the process and you can demonstrate to HMRC that you have got a process? Chances are, if they believe that you haven't taken reasonable care, and they will go back for any POI and IC liabilities, plus the apprenticeship levy, if that applies to your business. Interest will also be applicable, and penalties. The penalties, depending on what behaviour HMRC believe you've gone down, then they will apply the appropriate percentage of penalties. Now, clearly, they have said that for the first 12 months, they will take a bit of a light touch on the penalties side. And of course, there is the reputational risk, not just to your clients, but also with that individual that you have to manage. So I know it all sounds quite obvious, but those are the consequences of getting things wrong. So what next? What does good practice really look like? So I'd be very surprised if you haven't already done this, but the first thing to do, obviously, is to identify potential workers that are impacted by the rules. And the one thing I want to just point out, because I've had quite a few queries around this. So when I talk about the small company test earlier on, those tests apply to the engaging company or the end user. What I'm finding is clients coming back to me and say, look, we've got some pushback from our worker saying actually they don't meet those conditions, but actually it's not the workers that have to satisfy those tests, it's the engaging company. Otherwise, a lot of them will be out of the new rules, as we know. Okay. Undertake the assessments, be it through professional advice or using HMRC's tool. Documenting and delegating responsibilities. So what I really mean by that is if you look at an invoice coming to you, well, clearly for the labour element, that would have to go through the payroll for RTI purposes, but you've still got to settle that invoice. Quite often that'll be done through accounts payable. There'll be VAT element to consider as well. So how do you bring all that together? And I'm sure they'll be involving from the HR department as well. So that's what I'm talking about, delegating responsibilities. Setting up new payroll, POA references. What am I really seeing out there? Actually, it's no real need to have a separate POA reference. What I'm seeing is clients just setting up a separate cost center of payroll workers within the same POA reference. Clearly, the additional costs involved with all these changes, the obvious one is the employer's national insurance and the apprenticeship levy. But also what I'm noticing is because the individual workers now having to suffer the employees employees NIC and the POAE tax, the rates are obviously gone up a little bit. So all those things do add up to quite a hefty additional cost. What I'm also seeing is clients looking at other options. So question, do we just take that person on as a permanent employee? Now, clearly that comes with the risks and cost. But they're also looking at transferring that responsibility onto agencies and make them responsible for operating POA and IC rather than them taking all the employment rights on risk. But also, just like anything else, when HMRC introduce something, there's always going to be something there that people try and avoid. But so umbrella companies. Now, again, there's a word of caution there. In my view, an umbrella company is where they look after your payroll, they deduct POA and IC, and then pay that over to HMRC. That's what HMRC believe as well. There are a number of different structures out there, which I wouldn't necessarily advise you try and use. It's a matter of time before HMRC then catch up with you and you've got a problem on your hands. There is talk about extending employment rights. Again, Ginny will be more familiar with that sort of stuff. I don't know if there's any update on that at all.
Not at the moment, no.
Yeah, okay. But like I say, it is quite a topical subject. If in doubt, please seek professional advice. And with that, I'll hand over to Jeremy Chapman.
So my name is Jeremy Chapman. I head up the capital allowances offering within Cooper Parry. I've worked in capital allowances for too long, over 20 years. I've seen many changes. Probably some very interesting changes have come out in the last 12 months or so. Probably the biggest one is the super deduction, which has probably got everyone talking. Obviously, it's some form of recovery aid from COVID, but obviously it comes with some very sort of interesting rules and tests that you need to make sure you follow. Today, I'm going to talk about some of the green tax reliefs around capital allowances. There aren't that many of them left anymore, but I just think it's worth covering that area. We'll then talk about super deduction, how it compares to annual investment allowances, which hopefully you're all familiar with. And then finally, just a quick light touch on free ports, which would be very remiss of me not to mention, given that we're so close to one. Right.
The right hand.
I am.
There
There we go. Right. Okay, so green taxes. We all know why green tax reliefs are being introduced or have come about. It's to reduce images like this. We don't want to see smog in cities. We obviously want to keep our air clean. We want to reduce carbon, etc. So it was very interesting back in 2001 when they introduced enhanced capital allowances that were aimed at encouraging technologies to be green, reduce consumption, and both of energy and water. So it was a bit of a surprise when they then removed those reliefs. So they've gone as of April 20. So if you're planning to change your lighting systems to LEDs or change that boiler to an air source heat pump, or there's no specific reliefs around greening your buildings. Having said that, though, there are some green reliefs still around. The first one, and probably everyone who's got a company car will be well aware of this one, is the new and unused cars that are electric or have zero emissions, essentially. That relief's around until 25. They keep extending that, obviously with the policy of changing in 2030 to non-combustion engines for all new cars. That potentially could hang around for a little bit longer, but as soon as adoption sort of really takes hold, I can see that one going. Likewise with the goods vehicles, zero emission vans, so it's still something worth considering. And why is this a great relief? Well, this is 100% relief in year one. So you're going to get your tax relief pretty quickly on these things. There's no tax credits like the R&D system. They went when we got rid of the energy sort of consumption reliefs. The next one is the electric vehicle charging point. That's only around until 23 at the moment, but they've already extended that relief once. So I fully expect them to extend that relief again to encourage the early adoption of electric vehicles. Points to note about sort of whether there's a PAYE issue about charging at work and things like that, but it's still worth considering that from a capital allowances point of view and tax relief that might flow from that. And finally, one that probably isn't going to be relevant to the vast majority of businesses at all, and possibly not to anyone within the room, but it's the gas refueling stations for dispensing natural gas, biogas, or hydrogen fuel for the refueling of vehicles. So it's probably not a common one, and I'll be perfectly honest, I have never made a claim for that for any of my clients. So it's only around till 25. I can't see them necessarily extending that one, but they might do. Okay, so those are the green reliefs, effectively the enhanced capital allowances available, and they're all 100% year one. On top of that, there are other reliefs within the capital allowances regime that can encourage you to make your building greener or tidy up your building or area. And these are these two. So the first one's thermal insulation. Adding thermal insulation to an existing building is eligible for what's special rate relief, special rate pool. That's currently running at 6% per annum on a reducing balance basis. So it's not that great, But what you can bear in mind is that if you can achieve that, you can claim annual investment allowance on that. So that first million, and I'll come on to annual investment allowances in a minute, but that first million of improving the thermal insulation of your building could be 100% in year one. Now, it's not just adding loft insulation. It could be changing your windows from single to double glaze because you've improved the thermal capability of the building. It could be overcladding the roof because you're containing something like asbestos and you're adding thermal insulation. It could be overcladding the walls. So it's not just as simple as loft roll insulation. So just bear that in mind if you're thinking about making your buildings efficient. With the minimum energy efficiency standards requiring landlords to up the performance of their buildings, this is going to be more important as the older stock needs to be improved. It's already biting and it will continue to bite both domestic and commercial, so residential and commercial property. The second one is land remediation relief, only available to companies, not partnerships, trusts, individuals or anything else. But if you're cleaning up your buildings or property, and it's not just buildings, it's the land and the buildings, you'll be entitled to 150% relief in year one. So this is a very beneficial one to have, and it can relate to things like removing asbestos. So if you've got any old stock, any old buildings where you're removing asbestos, that can be relevant. Equally, it can be containing the harm. So asbestos is considered a harm, like many other pollutants. So if you contain the asbestos, you don't have to necessarily remove it. You could still potentially get that relief. It can also apply to things like Japanese knotweed, which we don't have too much of in the East Midlands, thankfully, but we do have. Funnily enough, one of the partners was asking me about Japanese knotweed the other day. He was thinking about buying a house that had it nearby, and I was saying, whoa, make sure that's treated. It's not a great plant to have in your garden, let's put it that way. It could potentially bring your building down if it got too close. If you treat it, great, but you've got to treat it on site. If you take it off site, dig and dump it, you won't get any relief. So it's important to make sure that your remediation strategy makes the tax relief possible. Okay, so it's just something to bear in mind in terms of the green incentives. Right, now on to the main part, I suppose, the super deduction. Now, hopefully back in March, everyone heard the Chancellor stand up and mention this. It was a big eye grabber. And there was a lot of communication from clients at the time asking, what does this really mean? How does it apply to my business? What if I'm leasing equipment? What if I'm renting properties? And there was a lot of toing and froing, and we sort of communicated with HMRC, sought clarity, and a couple of changes came through in the final legislation that we were quite grateful to see, especially for our sort of landlord clients. So what is it? 130% relief in year one. So the eye catcher there is the 30% uplift, obviously. It's only available for companies. So unfortunately, partnerships, sole traders, and any other sort of form of entity would not be able to claim this. So it's a big disadvantage unless obviously you operate through a company. This is only available to items that would be classed as general plant and machinery, so fit into the main pool. Now that typically is all your loose equipment, your manufacturing equipment, some fixtures within a building, but not all. So it can be quite worthwhile, especially if you're undertaking a construction project or fitting out a retail environment, or for example, or indeed buying a new printing press or sort of plastic molding machine or whatever. If you don't satisfy that criteria, you could still potentially claim the 50% enhanced deduction, which relates to special rate pool items. Now, those are typically comprised of those 5 items in that list. Unlike the general plant and machinery pool, which is sort of an amorphous, slightly undefined, other than case law, classification of assets, the special rate pool is very specific. It relates to these 5 items only. So heating and ventilation systems, electrical systems, hot and cold water systems, lifts, and external solar shading. It also relates to thermal insulation as well. So if you're thinking about greening your building, you'll get it into the 50% enhanced deduction, but you won't get it into the 100% one. Okay. That list is fairly defined, but obviously it covers most of the services that sit within a building. So if you're constructing a building, that's the area that you're probably going to be looking at. Now, 50% doesn't sound that great, and it is only the first 50%. The other 50% you then get at 6% per annum on a reducing balance basis. So it takes a long time to get the full relief out of that. So super deduction has some real pluses. It has some not so great pluses, but some pluses. There are no limits, though. So if, as the Chancellor gave in his example, you can spend as much as you want, and as long as you're satisfying the other criteria, you will get this enhanced deduction. It's a very generous relief in that respect. And I think it's very much obvious that it's aimed at every business. The annual investment allowance is aimed at probably the first 96% of businesses, but that top 4 really large businesses, the annual investment allowance is pretty meaningless because they're spending so much every year that $1 million year one relief isn't that big a number for them. But this does apply to everyone. So every big tower block that's going up in London, every large PLC that's investing heavily at this point in time is going to take the benefit of this, just the same as every SME will do. There are some exclusions. The super deduction and the enhanced deduction are not available for second-hand or used asset purchases. So that's a key one. So it's got to be a brand new asset. And you can see why. It's encouraging industry to start producing new stuff and getting back to work, as it were. It's not available to plants and equipment lessors. And when it first came out, it was also thought that it wasn't going to be available to commercial landlords as well because they lease their assets. Okay? They have actually categorically said it is available to commercial landlords now. So that's a real plus. And that came out of the furore that sort of circled it when it first was announced. So they stepped back from that. And I think that's a really positive step from HMRC and the Treasury. It's not available in the period that your trade discontinues for obvious reasons. They don't want to give you a nice tax boost and then you close your business. And finally, it's not available on cars. So that's a key thing to bear in mind. Even green cars, so zero emission electric vehicles, it's still not available. Okay. There's a couple of things to bear in mind, and this is it's probably more about how you exit super deduction rather than how you get into it. First off, if you dispose of any assets that you've bought and claimed super deduction on, there is a clawback by way of a balancing charge. So you have to stream your assets and track them, because it doesn't just run till 23 when this super deduction ends. It will continue forever. So if you sell your printing press in 5 years' time, you will get a balancing charge on it if you've claimed the super deduction. It doesn't go into the pool and just get wound down through the pool as most other capital allowances disposals would do effectively. The second point is that if you dispose of that asset before March 23, you will get an enhanced clawback. So you'll get 130% of your sales proceeds will be deemed your proceeds for the purposes of this calculation. So it's important to watch for that if you're thinking of disposing of it. I mean, I appreciate if your piece of equipment gets damaged in a fire or it's stolen, there's not a lot you can do about it. That's just life. But just track that. And the timing is going to be crucial because March 23 is when we then introduce the 25% corporation tax rate. So we're going from 19% to 25% for the larger companies. The enhanced clawback won't apply post 31st March 23. And the reason for that is they're saying that companies that dispose of after that period will be caught by the 25% rate. Now, not every company is going to be caught by that, but that's the thinking. So that's why the enhanced deduction and the enhanced clawback ends at that point. The next point to note is, as I mentioned, it finishes in March 23, but if you buy something in an accounting period that straddles that date, you won't get 130%. It will be time apportioned down, regardless of whether you buy before or after that March 23 date. And that's an important point to note, so I'll just let that soak in for a second. If you buy something in January 23, you won't get 130% on it. If you've got a December year end, you'll probably get about 108%, 109% on it. Okay, so timing is critical on that. It's important to make sure you get that right. And if you're going to invest in a large bit of kit, it might be worth extending your accounting period to March 23 or reducing it to March 23. There's a lot of other things to consider, obviously, and it depends on the size of the piece of kit you're buying. But that's just something to bear in mind if you want to make sure you're getting the full benefit of it. Okay, so finance agreements. I mentioned finance agreements in terms of the leasing and hire purchase. There's a slightly extended test, slightly different test. So it applies to persons to whom the equipment is bailed or hired, and is the person who incurs the expense. So it's a slightly narrower test. It is marginally narrower. So if you're normally buying stuff under hire purchase, lease purchase, you're probably going to be okay. But our advice is you probably just want to get that checked. Make sure it satisfies these 3 key tests before you commit to it and assume you're going to get your super deduction. Okay, I've mentioned annual investment allowance. I'm just going to gallop through this because this hopefully is old hat to everyone. It's up to December 21, it's £1 million per annum. Okay, from 1st of January 22, it's £200,000 per annum. Now, if your accounting period straddles that date, there's a transition period, so you time apportion both elements. But don't assume that if you're a March year end, you're going to get 3/4 of the million and 1/4 of the 200,000 and be able to buy an asset after December for about 800,000 and still be okay. You won't get the full annual investment allowance on it. So it's important that you manage that as well in terms of timings. Of course, we may get to 22 and he may extend it, Chancellor may extend it, but not definite yet. So this is available for businesses, sole traders, partnerships, but not mixed partnerships and not partnerships where the partner is also a partnership. So benefit of this is a wider availability than just the super deduction, which is purely companies. Okay, so you have to pick which one. Not available for cars and obviously not claimable in the period of cessation of trade. With annual investment allowance and super deductions, it may be possible to still get 100% relief on pretty much everything you're spending at the moment, if not more. And also, if you're undertaking any R&D, still don't forget that there's the R&D allowance on capital expenditure, which gives you 100% relief in year 1. So that's another area that you should still be considering in terms of your capital expenditure. Okay, final topic, free ports. Okay, the rationale for this is to boost businesses, improve planning, make it easier, extra infrastructure funding, customs processes to improve, national insurance reliefs, probably a hot topic at the moment. Business rates relief, again, with the other reliefs coming to an end, this might be a thing that's worth considering. SDLT and other tax breaks. There are 8 locations at the moment in England. One of them is East Midlands Airport. Now, it's a huge area that they talk about. They talk about 40-odd miles area, but actually it's 3 key development sites within the East Midlands. So there's the intermodal park at the A38, A50. There's the around the airport, but very near to East Midlands Gateway development. And then there's the Ratcliffe Power Station area. But they zone round the whole of that and say that the whole of the area is going to benefit from it. But it's only those areas where if you undertake building works or locate, that you're going to be able to claim some of these reliefs. And these reliefs are not all the same in every location. Some of them vary slightly. It's available between March 21 and September 26. So quite a narrow window. If you're planning to build a building, get in there and start operating, you're running out of time already, surprisingly. So the tax breaks in terms of construction, enhanced structures and buildings allowance, which hopefully you're aware of the structures and buildings allowance, 3% straight line on assets. This is 10% straight line, so definitely a massive acceleration in terms of that relief. The enhanced plants and machinery allowance, that's 100% relief, but when you think about the super deduction, annual investment allowance, that may not be so great, but as things change and those reliefs drop away, this might still be worth having. There are clawbacks provisions if you don't use it in the Freeport area for the 5-year period. It also extends to special rate pool expenditure as well as general pool. So all your services within a building would be eligible under this 100% enhanced plant and machinery allowance. And that's different to the old enterprise zones that have only just finished, which only were applied to general plant and machinery, not special rate plant and machinery. Okay. And that's me done. So I'm going to hand over to Gemma.
Super. Good morning, everybody. How are we? So you've had about 45 minutes sat still. So can I just ask you all to stand up to begin with? Trust me on this one. We're just going to give our legs a quick shake, give our arms a quick shake. If you want to have a stretch, have a stretch. And you can sit down again. Thank you. So hopefully you'll be a bit more comfortable sat down now you've had a bit of a stretch out. So I'm Senior Manager here at Cooper Parry in Private Client Tax, and I'm going to speak to you about employment taxes, employees working from home and working from home abroad. So it's quite a hot topic at the moment. So let's make sure we go the right way. Yeah. So COVID, big impact on how we work, how your employees work, how we still function as businesses to keep moving forward whilst we can't come into the offices. So it's really accelerated how remote working is dealt with. So we've all been thrown into remote working. We haven't really had time to plan, to figure out how we're going to deal with it, set policies. And that's caused quite a lot of issues across the board for both employees personally, for their personal taxes, and then for your companies and your businesses as well. So I'll start first with home working and we'll move on to overseas working afterwards because that's a little bit more complicated. So we'll whiz through this bit first. So the basics. You've sent your employees home. You can't work through COVID. We can't have the offices open. You need to set up at home. Be productive. You can provide your employees the assets needed to enable them to complete their role. So computers, if they haven't got a desk, you can give them a desk. That's fine. If they haven't got a chair, you can give them a chair. Tax-free, no benefit on the employee. Deductions through your accounts. But the private use for those must be insignificant. So if they're working maybe part-time, doing 3 hours a day, for example, and the rest of the day they're sat there playing computer games on it, it's not insignificant private use. So insignificant is a bit of a wishy-washy term. There's no set definition for that. So use a bit of kind of common sense, and then we'll have a look at hours apportionments and see what sort of private use you're using for that. Your employee, however, might come to you and say, I want to buy this desk. Can I expense it? Very similar. If it's a standard desk, that's fine, and they're going to use it wholly and exclusively for work purposes. But if they've got an all singing, all dancing, electrical, move up, move down, flashy lights desk, that's not necessarily wholly exclusively for the purposes of your work. You've gone above and beyond what you would expect there. So you'd think twice about allowing that expenditure. So the important takeaway for here, are your P11Ds correct? Have you supplied your employees equipment above and beyond? Have you paid above and beyond wholly and exclusively? Do you need to report those as benefits on their P11Ds, and do they need to be taxed on it? Similarly, travel, if home is their temporary workplace, which it will have been for a lot of people the last 2 years, you can claim expenses, mileage, for example, going from home to an office to a client. And that's only limited for 2 years. So if they're continuing, if your policy is going to continue for flexible and remote working, you need to have a think about where the contract says their place of work is, so where they can claim those expenses from if they're travelling. Landlines and broadband, something else that lots of people have asked to claim. Most people have landlines and broadband as standard at home anyway, so they can't put through the full cost of that expenditure through. If you, for example, had to upgrade your broadband because it just isn't capable for the work that you're doing, particularly, say, IT support, if you need a faster broadband speed, higher connection, then that additional expenditure is wholly attributable to your work. So that's fine. But if you've said, no, we'll pay all of your home broadband costs, you've got a big chunk of personal use in there. So you've got to be thinking again about P11D benefits. So HMRC have said we will give you tax-free payments of up to £6 a week. No records needed, but for this you have to work from home. You can't have the option to work from home or from the office. So when the government said nobody can go into the office anymore, everybody has to work from home, that's fine. You've been forced to work from home. But if you've chosen to work from home, so for example from now onwards, you can't claim this because you've had the choice to go back. So you might find employees want to claim more for their home expenditure, which is quite often a comment from employees across the board saying my heating bills have gone up, my water bills have gone up, etc. They need to be able to prove that that's happened. They need to be able to provide receipts, and you'll also have a look at apportionments through the number of rooms in your house, maybe even down to the number of people, the number of hours you spend working, the number of hours you spend being present. But fixed property costs like your mortgage, your rent, your council tax, and again, coming back to landline and broadband, you can't claim for that because you've had to pay for that anyway. Working from home does not affect your mortgage costs. So you can't include that in your work from home calculations. So I've whizzed through that because this is where things get messy. So working from home overseas. So we've had lots of employers come to us and say, Doris has gone to Spain to holiday home for 6 months. Well, during COVID, she's going to stay there. She's working, doing all of her daily duties. What do I do? Do I need to do anything? And 9 times out of 10, it's too late to do any planning because she's been there for that 6, 9, 12 months already. So the things that I want you to go home and think about, or go back to the office to think about whether you've got a problem, follow on these next few slides. So the risks to the individual first. You need to make sure that your employees don't become tax resident in the country that they've gone off to work in. So you're potentially counting the number of days that they've been working in the country that they've gone to, what their working patterns are, whether they've got permanent accommodation out there. So lots of different factors to determine whether they're tax resident in that other country, and whether they've broken UK residency, which will affect their UK tax filing, potentially your payroll, or whether they've established residency in that other country, in which case filing obligations in that other country as well. So in relation to that, if you're resident in both countries, you're potentially double taxed. So then you're going into looking at treaties, seeing who's got taxing rights on that income. You may also have to file your tax return, social security. So you get to pay your national insurance. Following Brexit, the rules on national insurance across the European countries, if you go off to work in a different country, aren't as straightforward. So there's lots more complications that have arisen there that you may not necessarily have thought about previously. The employment law, whether that employee being in the other country is establishing employment rights in that other country. So working time, sick pay, maternity pay, holiday pay, is them working there for that number of hours, establishing rights in that other country. And then tax filing penalties, if they've had no idea that they're liable now to file tax in that other country, penalties, interest. So we need to have a really good think about this. If our employee has told you, I'm going over here to work, or I'll be working from my holiday home in Spain or wherever, do you have an obligation to that employee to say, actually, have you thought about this from your personal point of view, irrespective of all the company stuff? So things that you might need to ask them or get them to consider. Number one is work visas. This is a really hot topic, particularly after Brexit. You can't just assume that you can go off to another country and work from home, even though you're still employed by a UK employer. We've had particular problems recently with the States, with people just going off and working from the States. Suki's nodding. Suki and I work together quite a lot on employees that get sent abroad. Suki does the corporate side and I do the personal tax side. So we've had lots of employees go off, and actually some of them haven't even considered their visas. They come to us too late. We ask the question and they end up being kicked out of the country because they haven't got the right to work, and it causes all sorts of problems for both the business and the employee. So you might want to consider asking them to track the number of days they spend overseas, the number of work days they spend overseas, where they've gone, what the country's tax rules are over there. So you might think that you're on my payroll, you're doing my UK duties, it doesn't matter, but it can do. So don't just assume that it doesn't affect you. And then also as an employer, whether you've assigned them overseas or whether they've gone overseas on a flexible working policy. So that just can alter what their rights are and what your responsibilities are. So it's a bit of a duty of care, duty to assist your employees, making sure you know that they're okay for their personal taxes. In line with that, so your employee has disappeared off to New Orleans to work for the weekend with all the hurricanes and the storms. Would you know? So your employee hasn't told you because you've got a flexible working policy. They don't really need to tell you where they're going. Do you have a duty of care to know where your employee is whilst they're working, whilst they're on your time? Do you know that they're safe? Do you know that they're in a safe environment, that their equipment's secure? So all of the surrounding factors. So if you don't hear from that employee, what do? Do you have procedures in place to make sure that that person's okay? So it's not just the tax issues and the legal issues, it's a bit more of a moral responsibility for looking after your employees as well. So let's go on to the business. As a corporate perspective, you want to make sure, well, you might want to create a permanent establishment or corporate residence of the company in that country. So if you want to expand overseas, that could be a really good thing, but you'll need to have a look at how you do that in particular. The danger is that you can accidentally create a permanent establishment or corporate residence in another country, which means that you're liable to tax, all of the business laws over there. You might have to set up a payroll, report social security, withhold taxes. And then again, as I mentioned earlier, that employee then is subject to all of the employment law in that country instead. So there's a huge black hole of obligations that you could fall into unknowingly because your employee has gone over there. So things to consider on that aspect, your company goals. So do you want to move over there as a permanent establishment? Are you trying to branch over abroad? Or are you just being really nice to your employees and letting them work flexibly anywhere in the world? So you'll be accidentally creating another branch or permanent establishment. You need to consider the tax rules for where your employees are going, the corporate tax rates. So you might find once you've had a look through what all the rules are in that other country that actually this is a really good idea. This is quite lucrative for us to send that employee there to build up a permanent establishment, build our business over there. So that's another thing to consider. Your salary, if your employee is gone, are you going to pay them in pounds still, or are you going to pay them in the currency that they're from the country that they're working in? And then there's an exchange rate risk. Are you going to pay them on a net pay basis? So if the exchange rate goes up or down, they still get the same take-home pay. And deciding how that's going to work for you as an employer and for them as an employee. The number of days employees present, I will keep droning on about that because you really need to keep an eye on the number of days that your employees are abroad. What their job description says. So I've put on there, decision makers are dangerous. So if you're sending, for example, an admin assistant across, or they've asked to go across to, say, Spain, and they're doing their normal admin assistant duties, they're providing a service to your company, they're not making any decisions on behalf of the company. So they're quite safe. For a decision maker, if you're going out making decisions, entering into contracts whilst you're based in that other country, you're at really high risk of creating a permanent establishment or a branch entity out in that other country. So the seniority level basically affects how dangerous it is for them to be remote working in that other country. And I come back again to the work visa because it's just so important. I really don't want you to forget. So what do I want you to do as a company? Create a policy. So based on the company goals, consider what you want to do. Do you want to create a branch overseas or not? And then you want to base your policy, your flexible working policy, remote working policy on those goals. Create a frequently asked questions document, if I can get my teeth in, to go hand in hand with that policy. So if your employees want to go and work overseas, they've got a really quick reference guide on what your guidance would be, how to prevent your company falling into all of the pitfalls and dangers of additional tax, additional legislation, just to protect yourselves, really. So your employee can't come back to you and say, well, why didn't you tell me this? Why didn't you tell me this? And then you can't go back to your employee and say, you've created this big minefield for us. Why didn't you tell us this is what you're doing? So it's really key to cover yourselves and to cover your employees as well. And then you also want to have a think about where you should be supporting your employee tax reporting. So if you've allowed them to go overseas and you've agreed that that's fine, they might then become tax resident, have employee personal tax issues overseas. Are you going to support that cost for them to find out how they're going to be taxed, report their income? So if you do, you're looking again at P11D benefits for paying for their taxes. And then you're also looking at the wider picture. Are you giving any support to the family as well? But if they've gone on their own accord, you might just say, no, your problem, but this is what you need to look at. Make sure you do it. So it's deciding really what your policies are, what your standpoint is for those employees. Communication is key. So keep your employees informed. You don't know what you don't know. And most employees won't know that they could potentially be causing you a problem overseas or remote working from a holiday home. So if you create a policy, put it out there, at least they're aware of the situation. And then if there are any problems, they can come and speak to you, or at least tell you that that's what they're doing. Because for all you know, they're sat in their bedroom for 6 months working, but actually they've been in a different country. So it's really important to know where they are. A summary of residency rules. So you might just want to, so on our website, for example, we've got a flow chart, so you can just go through and see whether you've broken residency, whether you're UK resident, and it's really easy to follow. It's a really basic document. So if you do have an employee that's gone overseas, you can refer them to that document and they can just have a really quick look to see whether they're potentially broken residents. Employee job descriptions, keep those up to date. So if you've had somebody that's been promoted all the way through, they're now a decision maker, but your records might not necessarily show that. Just make sure that you're up to date on what people are doing. So you don't suddenly find out that Doris is now entering into contracts when you thought she was just writing letters, for example. So be really careful on what people are actually doing whilst they're working overseas. And again, work visa should be a priority. So consider your longer term flexible working policies. Really have a think about whether you want to let them have free rein on working overseas, working remotely, working from home. Whether you need to change their contracts. So are you going to change an employee's contract to working from home as their permanent place of work? So where can they claim expenses from? Look at creating employee tracking systems. So you know where your employees are. Are they at home? Are they abroad? If they're abroad, which countries are they in? If there's a national disaster in that country, can you make sure that they're safe? So it's that moral obligation again. And then security issues, cybercrime and physical theft. So if they're in a particularly notorious country for theft, or if it's particularly dangerous, you might like to know that just so you can maybe check in a bit more often, increase the security on their laptops or their phones, or create security policies in line with looking after your equipment. So they might not want to leave their laptop on the table overnight if they're in a certain country. I won't name any. Or you might want to specify to them that they lock those laptops away. So considering whether you want to commit to that long-term flexibility or not, and designing an appropriate policy for it. So that's a really quick whistle-stop tour. If you do need help on any of those questions, please contact us. But I just want you to think about where your employees are, what they're doing, and whether they're going to cause you a major headache in the future. So thank you all very much for listening.